have come here to chew bubblegum and kick ass, and I'm all out of bubblegum.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Real Towers. But please, don't hold that against me. Welcome to Thursday, everyone. I hope your week is going well. We've got another interesting interview show tomorrow, so make sure not to miss that. I think you'll all get some good information out of it. I'm really happy with the guests we've been getting. I've only had to turn down a couple, and I've only had to stop one interview right in the middle and not use it. But anyway, it's been great. So hopefully you guys have been able to get some good stuff out of it. We've got an interesting topic for you today. The good folks at HomeUnion have come out with their power rankings list for different metro areas. They select a very limited group. So I mean, this is good. This is good info. This is the second year they've done it. The reason why this one is sexy is because it's forward looking. We've talked about other data that has come down the pike that talks about if you had purchased something a year ago, how would your property have performed, right? And that's great, particularly if you can do a little bit more homework to figure out whether or not that's a continuing trend or whether we've kind of hit the payoff on that and you kind of missed the boat by not buying a year ago. This is a report that's designed to aim you towards making the right purchase today so that a year from now, you'll be happy you did it. So I love that kind of data. That's exactly what we want to look for in terms of us deciding where we want to put our money. Now, this is focused on the single-family rental markets, and these are the markets expected to perform through the year's end. For this study, the firm analyzed markets based on local demand drivers and limited risk of losing renters. So higher demand and lower probability of losing a tenant, right? So that was the key here. Now, specifically, the research services over at HomeUnion measured the following things to create their list. Number 1, employment. Number 2, rent growth. Number 3, short turnover time. Number 4, rent to income ratio. Number 5, construction permitting levels. And number 6, cap rates returns. So all things that are good for you as an investor. And you know what? Something I like to point out is so many folks feel intimidated by this. And you know, you really shouldn't, even if you are someone who is taking the most conservative tack. And what would that be? I think that would be someone who purchases a home. For instance, they need someplace to live. They're purchasing a home, and maybe you're being a little bit more aggressive in that you're purchasing a home that you specifically are looking for a home with features that would allow you to facilitate it generating some income while you're living in it. So maybe it has in-law quarters, maybe it has an income suite somewhere involved that would allow you to do that to get a little bit more cash flow going. That would be probably right on one edge of the spectrum of buyers who do it. And the other would simply be someone who buys a home that fits their needs now that they ultimately think would make a great income property. And their plan is not to sell it, but rather to manage their finances now, do things now to help them get to the point where they can come up with a down payment for the next property. Or if the markets are kind to them, use the equity from this existing property to make the purchase on that next property and be able to just rent this property out that you're currently occupying somewhere down the road for positive cash flow. So what I'm suggesting with this train of thought is if you are a buyer and you're only kind of vaguely entertaining the idea of jumping into being an investor, maybe you're very enticed by the idea, but the idea very much scares you. Well, you're going to buy a home for yourself anyway. So why not use this data as a way to direct you in the direction that might give you more options to exercise those investing muscles that you're kind of aching to get going. Okay. So just something to keep in mind, that I think this is data that's good for anyone, ranging from the folks who just casually want to get good info on what's going on in the real estate world, all the way up through the investor who's still trying to break through on that first deal, up to the person who's been doing this for years and is just really trying to spot what anyone else would want to spot, and that is good opportunities. All right. And there's also a couple of interesting things. I love it when stories cross each other, when they kind of have a little bit of crossover, and we have a little bit of that today. We're going to go ahead and look at this list. It's actually a list of the top 30 or ranked. There's 30 metro areas ranked, but we're not going to talk about all 30. I might quickly mention some of the other ones, but I really wanted to hit the top 10 for sure, because I want to take a minute to maybe look at one of these at least and do a really quick assessment. Right? Let's go actually look at homes for sale and see what we can see, or at least get a little bit more information about that specific marketplace. Okay, so let's go ahead and jump in and start at number 10. And the other thing to keep in mind is I like this list and I'm not fooling around with it. I know that with past lists, I have sometimes gone back and jumped in and looked at other areas or touched on property areas or regions or metro areas that were outside of the top 10 that we were originally covering, simply because I saw opportunities potentially in some of these other ones based on low barriers to entry, or because one particular element of what they were measuring was so good that it was hard to resist. This is kind of true here too. I'm seeing a couple areas with such great cap rates that it's hard to ignore, and they're not in the top 10. In fact, I guess the highest cap rate I'm seeing, the highest cap rate I'm seeing here is not even in the top 10. It's actually 21. But I like cap rates. But a lot of people might argue, well, it's a high cap rate, but it's not as much of a moneymaker as some other communities. But given the amount you would invest, that's what the cap rate is about, right? So it's one I wouldn't mind bringing up. So we'll talk about that. Maybe that'll be our bonus community that we'll talk about in today's show. All right, so let's go ahead and jump in. Number 10 is Minneapolis. And Minneapolis, if I recall correctly, has shown up. The Minneapolis-St. Paul metro area has shown up on a variety of reports that we've covered before in terms of good numbers for investors. Now, coming in at number 10, I think it has some pretty attractive elements to it. It's not the cheapest community on our list in the top 10, but it's reasonable. I think that in terms of barriers to entry, I think that this bar is low enough that it would be reasonable for some folks. The median investment home price is $172,300. The median rent is $1,513. And let's step back for a second and apply some of these strategies that we have talked about before that you can use to quickly, on the back of an envelope, evaluate these kinds of numbers. And remember, we're using averages, and odds are you're not going to find a home that is exactly this average, but you'll find properties that fit in the mix, and you'll find some that are better and some that are worse, but you'll be able to find them. If we have a purchase price, a median purchase price of $172,300, and that median rent is $1,513, if we take that $172,300 and we do the 1% rule. Now, remember, the 1% rule is where you take the total amount after a 20% down. So you take the total, you reduce it. Now, in this case of $172,300, 80% of that is $137,840. And 1% of that is $1,378.40, which would mean in our really quick first touch of a toe into the water to see if it's comfortable, we would want to have a rent that is at least $1,378.40. Well, we have that. $1,513 is more than $1,378. So in terms of doing a really quick analysis of that 1% rule, this fits. And the cap rate in Minneapolis sits at 5.8%. And remember, this is one of those things where there's a decent potential return on these things. And people say, well, I'm not going to make that much on this investment. Well, that's right. But if you look at it comparatively, it's about how hard your money is working for you. So this is an area where you can get into this market for a little bit less and potentially have it, instead of buying, if you were someone, for instance, who was doing what I've suggested folks in my market do, I've suggested for those folks who have that $1.6 million house in San Francisco, or that $2 million house, or a $1 million investment property in San Francisco, sell that thing and buy 10 of them in some of these other communities that are going to diversify your portfolio and have you make more money than you'd make in San Francisco in the near term, right? It's hard to argue sometimes with the appreciation that tends to happen in places like San Francisco. But if you're looking for really good, steady income on a month-to-month basis, it's hard to make that argument, at least right now. You would not be positive. If you were to buy a property right now and rent it, you would not be positive cash flow right off the bat, unless you're going mostly, if you're paying all cash, of course, right? If you don't have a debt to serve there, but it's all about how much leverage, and your obviously your cap rate suffers from those things. So just understanding that where we put our money, it will help define how hard it works for us. Pick the right market so that the market is working for you, rather than you getting a minimum amount of money in return for the investment that you're making in that community. Okay, sorry, I feel like I've beaten up this point too much. Number 9 on our list, and remember, this is a forward-looking list. This isn't what's performed over the past. These are numbers reflecting today, and because of the statistics that are seen for these areas, these are seen as good investments for the next year. So this isn't look back, this is look forward. And again, number 9 on our list, Atlanta. Atlanta has been on so many lists for so many different reasons. And it's one of those ones where you seem to either love it or hate it. I've had a couple of folks reach out to me. We've had guests on the show who've had good things to say about Atlanta. I've had some folks reach out to me and say, oh, it stinks. I had such low quality renters. And I hate to tell you that, but the bottom line is, if you have horrible renters, you need to screen your renters better. That's your property manager's fault. And if you're serving as your own property manager, you need to develop your skills on how to evaluate your tenants, your potential tenants. Again, just like we don't make money when we sell a property, we make money when we buy it, right? You have to buy it right in order to make that money at the end. Whether or not we have a good tenant isn't about once the tenant's in the house. It's about what you did before they moved in to help determine whether or not they are good tenants. Because a good tenant is already in that person before they move into your house, and you just need to figure out if that person's actually there or not. So as I said, Atlanta comes in at number 9. This is another great community because of the low barrier of entry in terms of prices. The average price is $131,000. Now, if we apply that same 1% rule again, we will get that, and we'll run through it before we actually even look at the other two numbers here. But that $131,000, you should key off of that immediately. 80% of that is $104,800, which means we should expect to get in rent at least $1,048 per month. Well, in Atlanta, the median rent is $1,243 with a cap rate of 6.4%. So those are great numbers in terms of meeting that initial pass. And of course, there's all the other due diligence you're going to want to do. This again is just a first blush evaluation of whether or not it's worth your time to go to the next step and more closely evaluate that marketplace. And clearly, Atlanta definitely meets that criteria. Now, this next one is interesting because I'm not 100% sure I buy it. We've had so much information relating to this market being overblown right now and being overpriced. In all honesty, I was up there, but I didn't look at Seattle. I looked at Redmond. And of course, number 8 on the list is Seattle. Much higher barrier to entry. The median home price is $450,000. And if we do our 1% rule again and check it out, that $450,000 mark, what we find is that 80% of that is $360,000, and then that means we need to make $3,600 per month in rent in order for that to meet our 1% rule, and it doesn't do that. The median rent is $2,218, so it absolutely does not meet our initial first gate to see if it makes sense, and it also has a cap rate of 3.3%. That is the lowest cap rate that made it into the top 10. And if I'm not mistaken, It's very interesting. The other community that has a lower cap rate is San Francisco at 2.5%. San Francisco came in at number 28. So another one of those super sexy communities that everyone wants to talk about has the lowest cap rate. And I'll bet when we run the numbers, we can talk about San Francisco in a minute. But anyway, the two worst performing cap rate communities are Seattle and San Francisco on that list. Totally makes sense to me. So I'm not real sure. I guess they see an awful lot of room to rise in Seattle. It would have to be that way. Given my concerns relating to sensitivities of the different markets, I wouldn't put Seattle as my number one go-to place, just to be honest. I think it's an overheated market that when cooler heads prevail, won't sustain that. All right, now here's another one. We had a guest from this community on the show recently who sort of tried to set us straight on just understanding the importance of getting the ground truth for these areas. That is Detroit coming in at number 7 with the median investment home price of $167,500. And if we go ahead and plug those numbers in and come up with our 1% rule, that would mean that the 80% would be $134,000, which would equal $1,340 per month is the minimum rent you'd want to be able to get. An average rent or median rent in Detroit is $1,406 with a cap rate of 5.7%. So that's pretty reasonable. And I tell you what, if there's a community, if you could make that argument, right? We just talked about Seattle. I think it's kind of fortuitous that Seattle and Detroit are right next door to each other on this list. I don't see the headroom for Seattle. Maybe there's numbers that HomeUnion looked at, or there's things that HomeUnion was aware of in their research that I'm not aware of. But I don't see tons of headroom left. I don't see a lot of rise left there. There may be. I don't see it. But Detroit, I think, has a lot of rise left in it. I think there's sadly, I don't want to say it out loud, but I almost feel like the only direction it can go is up. Is sort of the vibe I get from Detroit. But with this level of return, if you're safe and sane in how you get your ground truth on the market, and looking at the 1% rule, it looks like it's worth your time to check it out. All right. We're going to go ahead and do one more, and then we'll take a quick break. But number 6 on our list is Phoenix, Arizona. If we take a look at the 1% rule for Phoenix, we see $180,000 is the average price, which would give us $144,000 as 80% of that, which would mean we'd want to make a rent income of $1,440 per month. Phoenix does not do that. Phoenix median rent is at $1,264, a cap rate of 4.7. We've also talked about Phoenix. Phoenix has come up on our list as overheated markets, areas that might be a little bit too overheated. I wouldn't say it's as bad as a Seattle, but I think it definitely indicates to me that there may not be as much headroom left on that particular market. However, having said that, the difference here is not so great that I would completely dismiss Phoenix. I would say that it's a market where you definitely need to be a little bit more diligent on the front end. You need to be a little bit more careful. You need, I think, to identify very carefully the properties where you can turn them around the most, take the ones with the deficits you're most equipped to address, right? Because that's really how you add value to these properties. Whether you're going to convert it into a rental or flip it is really independent of that argument. But we are seeing just right off the bat, we're not seeing a correlation here just based on the 1% rule that would make me want to jump right in. Okay, we're going to take a quick break. We've covered the top 5. And then once we come back from the break, we're going to cover the last 5. One or two little surprises on this list, but we'll chat about that in a minute. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We are covering an interesting report. This is data or the results of research from HomeUnion. And what I like about this, as I mentioned at the top of the show, is this is forward-looking. We've talked about other reports that do that retrospective, right? Where we look back over the last 12 months and say, hey, if you'd bought a house 12 months ago in these locations, you would have made a killing. And then it's just up to you to decide whether or not you think that trend's going to continue over the next year, right? Not a bad way to start. I mean, as long as you do your due diligence and you get your ground truth, you're fine. It's just a great way to help direct your eye towards communities that are already doing well. That's not what this is. This is designed to turn your gaze towards areas that are going to be on that list in a year. So hopefully we've covered the 10 through 6 properties on this list so far, or 10 through 6 communities. We're about to cover the top 5. There's a few interesting ones on here. And again, like so many of our other lists, the areas that are not on this list, I think, are super important to note, because the reality is so many of the communities that aren't on this list are hyped as communities you should really care about. You should really want to put your investment dollars into. And as we preach here, let's let the numbers do the talking. I realize it's my marketplace. I realize I'm shooting myself in the foot when I'm telling folks not to invest in various areas. Why? There are areas where I would sell a house. So I'm not doing myself any favors by suggesting you not buy in some of these communities. But the truth is the truth. The numbers speak for themselves. And as I see it, my job is to try to explore these numbers in a way that gives you good information to help you make smart decisions. So in the spirit of smart decisions, let's go ahead and finish off this list. Now, number 5 on our list is Boston, Massachusetts. The median investment home price, again, this raises the bar a little bit. But remember, we have plenty of different communities here that are in this top 10 that are giving us really good numbers in terms of being a great place where you could jump in and start your investing. And remember, this is single family residential. So in terms of fear levels, lowest in investing, I find folks are far less fearful of single family residentials than duplexes, quads, and once you get to 5 units or more, it's a whole new set of rules. So I get that there's folks who are afraid of those. That's totally fine. So all of this should be very much geared towards folks who either have already decided that they prefer single family residential properties, or folks who are just getting into this and want to start with the property type that they're most comfortable with. So this should be a great list for everybody. All right. As I said, Boston comes in at number 5 with a median investment price of $333,800. The median rent is $2,337. Now, if we go ahead and do our 1% rule, we would want to make at least $2,670 per month. So it doesn't really qualify on the 1% rule. It doesn't mean you can't find deals that would work. It just means you might have to be more diligent in order to make that right purchase on the front end. So in terms of being able to find something more easily that's going to work for you, Boston maybe doesn't fit the bill. Okay. Next on the list, Buffalo, New York comes in at number 4. The median investment home price is $105,000. That gives us $84,000 is 80% of that, which means you'd need to make $840 per month in order for that quick 1% check to make sense. And the median rent on these properties in Buffalo is $1,285. So actually a really good difference there. You're actually seeing quite a bit of difference between what you would expect at a minimum and what you would likely get on a median type property. New York, New York. This one kind of surprises me. I'm not sure what the deal here is with this being number 3 on the list. Most of the stories we've read recently have not talked about how great the market is doing in New York. So, and maybe they're just specifically talking about the island of Manhattan when they're talking about these numbers. But I think you'll find here that these numbers don't actually make a whole lot of sense either. So New York, New York comes in at number 3. $431,100 is the median investment property price. let's not even go with that number first. Let's go with the number of amount of rent you'd have to charge in order for the 1% rule to make sense. And that amount is $3,448.80 because $344,880 is 80% of that $431,100 median. But the median rent is $2,148, nearly $1,000 off. That is such a huge gap between what the 1% rule kind of is supposed to guide us toward. The gap there is so large, I wouldn't even look. I wouldn't even bother. Now, the cap rate that they're putting here for New York is 3.9%. I think I forgot to mention Buffalo. Buffalo has an amazing cap rate, the best cap rate in the top 10 of 8.5%. Now, of course, that's reflected in what we talked about, the huge delta in the 1% rule, how much you'd probably make on a property in Buffalo, New York, in terms of cash flow. With the average sales price or median price being $100,000 and the average price of a home across the country, I think being just somewhere between $200,000 and $250,000. If you live in the average place in the country and you want to try to leverage a property you currently own somewhere else, you could sell it and buy two in Buffalo, New York, and enjoy that 8.5% cap rate. So it's just another way to have your money work harder for you. All right, number 2 on our list, another one that kind of interests me, is Miami. Now, Miami is showing an average investment property price or median price of $209,900. It's got a 6.3% cap rate. And according to the 1% rule, you would need to make at least $1,679.20 in order for it to be a reasonable potentially reasonable deal. And the average rate in Miami, the median rent in Miami is $1,980. So you've absolutely got a $300 gap there. That's a good gap, a $300 overage where we're performing better than the 1% rule. So it indicates a good thing. I would be a little bit more careful about Miami. Not just because of the recent weather-related problems, although I think that, sadly enough, that also presents an opportunity. Oftentimes, folks can get much better deals in scenarios like this. A lot of folks are put off by these kinds of things. So I think that represents a potential opportunity. I know when I was there for Hurricane Andrew, the months following Hurricane Andrew, I know lots of folks who invested in Florida real estate that were not sad that they did it. They were able to get some amazing deals and get some great cash flow going. And they were able to get things at a bigger discount simply because there was so much fear. And what you end up finding in places like this where a natural disaster occurs, folks who don't live in the state, but who live elsewhere and own properties in Florida will often be scared by something like this and put it on the market. They might feel like they dodged a bullet with not having had damage in the last storm, but it's an opportunity. It represents a window of opportunity for folks who might want to find an investment property in a place like Miami. Now, number 1 on our list, and this one is awesome because it's not only interesting because it fits in with so much other data we've heard, it also fits in with bad things that we've talked about. Dallas, Texas. Dallas, Texas has tons of people moving to it, tons of industry moving to it. It's growing like crazy. Its tax base is growing. However, on the flip side, it is having a huge problem with pensions. And we've talked about pensions and the part that they might play in a potential downturn. So it's got this double-edged sword thing where a community is doing exceptionally well on every metric you'd want to measure. But then they're also faced with this huge challenge in the form of pensions. All right, so Dallas is also another one of those where I think there's great upside to potential to Dallas without throwing you into a crazy barrier to entry in terms of being able to acquire properties. Now, is it as good as some of these others? Is it as good as Buffalo, New York? No, not at all. But at $199,300 as the median investment property price, it's still below the average for the country, which I think is good news. Here's the other part. Dallas is huge. The Dallas Metroplex is such a diverse and large area that it's almost laughable to talk about median numbers for Dallas. You need to, in looking at Dallas, you need to look at a whole bunch of different areas, sub-markets, sub-markets. There's a lot there, and I think there's a lot of potential upside to investing in Dallas. But let's go ahead and take these numbers as presented. At $199,300, with 80% of that would be $159,440. So that would mean, using our 1% rule, you'd need to be able to make at least $1,594.40 for that to work for you. And the median rent in Dallas is $1,630. So you're not making that amount by much, but you're making it. And the cap rate in Dallas is 5.6%. And the projections here are good. Clearly, Dallas has the highest, most attractive projections according to the folks at HomeUnion. They've been pretty good in the past in terms of making these estimates. So this represents a community where you're going to be spoiled for choice. Go ahead and pull up Dallas on some random day. Go over to Trulia, pull up Dallas, just do Dallas, Texas. And once you've done that, just look at the map and sort of let your eyes, I just did it. I'm looking at it. There's Dallas right there in downtown. And let your eyes just sort of scan down the listings it's showing you. Now, it's only going to show you 30 at a time. And at the moment that I'm looking at it, I'm seeing it showing me 30 of 6,231 properties currently on the market for sale. All right. And just to make it a little bit more interesting, let's go ahead and make it only single family residential properties. All right, great. Now it's showing me 30 of 3,893. And as I browse down my list, I'm seeing a home for $520,000, and not too far away from that, a home for $9.45 million. Over towards a place called Farmers Branch, $270,000. Now let's go ahead and make some real things here, right? We want to focus on properties that would be the most desirable. Now I'm going to use my general rule, my universal rule when I come to a new market, and assume that what we're looking for is homes that have at least 3 bedrooms and typically, and this isn't always true, 2 baths. That tends to be what I see in my marketplace as the most desirable combo. Once you get into some of these micro markets, you find that that may not be true. For instance, the market up where my son is going to college, I would absolutely be okay with a 2-bed, 2-bath. I think that would absolutely be a reasonable thing to do, particularly if you want to cater to the market of the student. All right, so now that I've got this entered, I got 3 beds, 2 baths, and I browse through here. I see 139,000. I see 125,000, 185, 925, 600,000, 370. Again, that $9.45 million house, 1.4 million, 1.5. Why am I reading off these numbers? This is a community that screams submarkets. And Dallas, the Dallas Metroplex, isn't just Dallas. It's then also Irving, Mesquite, Richardson, Garland, Plano, Grapevine, Euless, Arlington, Duncanville, Hutchins. It's gigantic. It is a humongous area that I think represents a lot of opportunity because of the variety, because of what you're going to be able to find there in terms of options as a potential investor. I think Atlanta is similar in that way, in that it's got a very large area that makes it a potentially interesting place to invest. But I can see why Dallas would be on this list. In terms of the things we talked about, or not the terms things we talked about, but rather the things they talked about as being important. Employment, absolutely. Everything I've read about Dallas shows really good numbers and a really good future for Dallas. Rent growth. Yeah, a lot of folks are moving there and needing to rent. Short turnover, rent income ratio, all these things, construction and permitting levels. All of these things indicate to me that Dallas would make a pretty stable, growth-oriented market to invest in. So absolutely, if you're someone who's interested in starting your investments, let yourself be drawn to these places that have really great returns. Now, let's talk about that one community. Let's talk about a couple of things. First, let's go ahead and laugh at the communities that we've been sold as the absolute places we should be going to that didn't really make the top 10. Washington, D.C. came in at dead last on this list of 30, and rightfully so, despite the fact that the barrier to entry isn't that bad. It's over the national average of 275,000, but I don't see a lot of growth there. Milwaukee was number 29. San Francisco came in at number 28. And just to be fun, let's go ahead and run the numbers on San Francisco. Now, they have the average price or the median price of $1,160,000 in order to play the game in San Francisco. 80% of that is $928,000, which would mean you need to make, if we're doing the 1% rule for San Francisco, you need to make on a monthly rent $9,280 per month. The median rent in San Francisco is $4,496. While that is a giant number, a ridiculously large number, a back-breaking number for folks who have to pay it, it is not $9,280. It is way off from that. It is obviously thousands of dollars away from that, nearly $5,000 away from that. And it just doesn't represent a good return at all. The cap rate is at 2.5% in San Francisco, the lowest on this list. Denver was in at number 22, which is also another hot marketplace, but I think, again, is another one with limited growth potential. So focus on these top 10. And what was the other one that had the highest number? 10.4, Cleveland. Let's go ahead and throw Cleveland in the mix here because I think Cleveland blends an awful lot of sexy stuff. So Cleveland came in at number 21 on the list. So not even the top half, but I think Cleveland is still worth looking at. We've talked a lot about Cleveland in the past. And I just don't understand why it's potentially an ignored marketplace. It's got a 10.4% cap rate. That is freaking amazing. That number alone should get everybody at least paused long enough to think about Cleveland as a potential investment. Now, I would want to educate myself more on what are the sustaining elements of Cleveland. Now, this list tends to indicate that it's not in the top half, so it may not have as great a growth potential over the next year. But if I'm already getting 10.4% right now on my investment, and here's the barrier to entry. It's the lowest barrier to entry on this list, unless I'm reading this list incorrectly. No, it is. It is the lowest barrier to entry. The median home price in Cleveland is $72,500. Now, if we do the math on that, that means that $58,000 is 80% of that amount, which would mean we need to make at least $580 per month in order for this to pass the 1% rule. Well, the average rent, the median rent in Cleveland is $1,158. You're doubling your money, right? You're doubling your money, or you're doubling the amount that you need to get in order for it to make sense. And again, is that a huge amount of money? I know some folks who simply say, I need to make a minimum of $500 positive cash flow on my properties once I've run other numbers for it to even make sense. Regardless of what everything else says, if I'm not making at least $500 per month, it's not worth the trouble. Here, you're absolutely making that, right? If that happens to be a metric that you guide by. I know some folks who say, hey, if the numbers all work out and the cap rates are all working out, whatever the number is that I quote unquote make, I'm fine with. But imagine the leverage you're able to do here. If you were able to go ahead and say, you know what, I am going to purchase a property in the top 10 list. I'm going to go ahead and jump in and do Baltimore. Or excuse me, Baltimore wasn't in the top 10. What was? It was in that ballpark. Let's say Miami. You decide to go ahead and jump in on Miami with an average price of $209. Well, you could buy 2.5. Let's round it up to 3. You could buy 3 properties in Cleveland that would each earn you that 10.4% cap rate, which would give you a cash flow of whatever it would give you. But add that up, and that's going to be more than what you'd make spending the same amount of money or having the same amount of money vested in an investment in Miami. So just keep all of those things in mind. I think this is a great list. Browse through and see where your city of preference is coming up on this list. It would probably be interesting to see if you show up in the bottom 5 where things are the worst. But let the math be the part of it that speaks to you so that you can make the best decisions possible on these. All right, folks. I truly appreciate you taking the time to listen to me on these subjects. As always, my number one goal is to leave more value on the table than you've invested in time, and I sure hope today we've done that. Thanks again for listening. Don't forget to take in tomorrow's interview. I think it's a good one. I think you'll enjoy it. Thanks again for listening. I'll talk to y'all next time.